want to explain about definition and financial statement about definition and function of accounting. Accounting is an art of recording, summarizing, analyzing, and reporting data relating to financial transaction in a business or company. Practitioners in this field, they are called accountant. Accounting itself has also been called the language of business. They measure the result of economic activity in organization and convey this information of various parties, including investor, creditor, management, and regulator. And then the main function of accounting information system: 1. Collect and store data about the organization's business activities effectively and efficiently. Provides information that is useful for management decision. In a manual system, this information is provided in the form of report into main categories: financial statement and managerial report. And then provide adequate internal control, ensuring that information produced by the system is reliable and can be trusted. Now I will explain the steps of accounting. One accounting cycle has 9 steps to go through, which is: first, collecting and analyzing. The first phase of transaction data in this accounting cycle starts with collecting data on financial transactions that are commonly called bank notes, not necessarily in the form of receipts, but can be in the form of a promissory note, or a receipt. Second, post after proof of transaction received and analyzed. Then the next step will be to include the value sheet on the transaction in the transaction notebook. This recording process is called journal keeping or post. Journal keeping could be done at any time during the day or in the afternoon before closing time. Keeping this transaction in accounting is called public journal. Third, transferring public journals to ledgers in general journals. Transactions are still mixed in with various other transactions. In this third phase, the transaction records were transferred according to the produce group. 4. Making an experimental balance and experiment towards the end of the book. These steps involve ensuring that the amount of transaction is equal to that of a credit transaction. The final balance on the guild account adds up. The balance on the negative innocent to account is also combined, then compared through. So how about no balance? It has to do with tracing why inequality is there. A journal of organizational adjustment was made to achieve balance. There are several causes of inequality among them. First, there are transactions that are miscalculation. Some cannot be recognized as a result of the implementation of the system of accrual. 6. The balance will be maintained. These 2 steps will need to be made to balance. 7. Compare the financial report after balances. A financial report consists of 4 types of reports. First, income statement, balance sheet, cash flow report, capital change report. 8. The closing of the accumulating income and cost books is reported for a period of time to prevent an income income and cost account from being mixed with the next period, it has to be closed at the end of each period so that the balance is zero. The difference in a rate between income and cost would provide certain value. This value is called profit or loss. It's called profit if a difference is positive, while the loss when a difference is negative. The loss, making this adjustment, was the last stage of the accounting cycle. Making this adjustment will mean to ensure that all income and cost account that all income and ensure that all balance will be ready to be used as the first balance of the opening credits to the future books.
Okay guys, in here I will explain about income statement. Income statement is one of the financial statements that show income, expense, and profit or loss generated of the company during a certain period of time. The main purpose of all income statement is to communicate the profitability and business activity of the company with end user and stakeholder. They are two different group of people to use this report. They are internal user and external user. The first, internal user. Internal user such a company management and the board of directors use this report to analyze the business as a whole and make decisions about how to run it. The second, external user. External user such as investor, creditor, and other people out of company. For example, investor. Investor use this report to know how profitable a company is and whether it will grow and become more profitable in the future. This is example for income statement. Now I want to explain about statement of change in capital. Statement of change in capital is one of the financial statements that must be made by the company that describes the increase or decrease in net assets or wealth during the period. Concern based on principles certain measurements adopted. The things contained in the report change in capital are as follows. Net profit or loss for the period and expense item, profit or loss along with the amount based on the related PSA key is recognized directly in PSA key. Effect of change in accounting policies and corrections to change the fundamental errors are stipulated in the related statement of financial accounting standards. Capital transaction with owners and distribution to owners. The balance of accumulated profit or loss at the beginning, equity period and exchange and reconciliation between carrying values of each type of capital stock. Adio and addendum on reconciliation between carrying values of each type of capital stock. Adio and addendum between carrying values of each type of capital stock. Adio and reserve on the beginning and end of a period that separately discloses each change. The purpose of preparing the report on capital change are to be able to summarize asset, payment, and investment and funds generated during one accounting period. Present the disclosure of change in working capital. And this is the example of capital change.
Okay guys, now I will explain about balance statement. Balance statement is a document that contains the company's financial condition for a certain period. Usually, this report is written for 1 year and will be used as a reference for the following year. Here are some of the benefits of writing a more complete balance statement, namely, as a financial analyst tool, if there are changes in implementation, to conduct liquidity analysis so that the company has a picture of its obligation related to liquid assets. Can be used as a means of reading the company ability to pay off short-term debt. And according to experts, there are three elements of a balance statement, namely assets, liabilities, and capital. After knowing the definition and elements and the benefits of a balance sheet or balance statement, beside me there are an example of balance statement beside me.
I'm going to explain about three components of accounting. Asset. In simple terms, assets are properties or rights owned by the business. There are two types of assets: current assets such as cash and inventories, and non-current assets such as land and building. Liabilities. The liabilities are economic obligation or payable of the business. Just like assets, there are two types of liabilities: current and non-current. Current liability is everything that due within 12 months after the end of the balance statement. And for the non-current is everything that not due within 12 months after the end of the balance statement. Capital is what is left after all other liabilities are settled. To make it simple, capital is total asset minus total liabilities.